Well, this is the thing is like there's a question as to how much of this is truly a surprise to like
Reaction's really muted, which means that there's no surprises. My guess is they kept right the same, but
yeah.
there is an element of bullishness or dovishness to the reaction.
All right. Yeah. First of all, we want to thank everyone for joining. We're giving people 2 minutes to join and we'll get started. In the meantime, we're talking about the trying to figure out what's going on with the Fed's fund rate decision here. Seems like no changes is the current.
Fed holds interest rates, but points to slowing economic activity.
Did they just have a higher than expected GDP growth?
They did, but GDP is backwards looking, right? They're trying to be a little more forward looking, and they're still trying to assess the impacts of tariffs and pass-throughs and things like that. That's unclear at the moment.
Yeah. It is fascinating to see the poly market. Poly market had this at 99% for the no change for. Oh, it's yeah. I mean, it's already moved to 100%.
Yeah. So did the Fed fund futures were very similar. So the reaction so far in markets is incredibly muted.
Yeah. We're going to give people another minute to join, and then we'll get started. And I guess the one potential macro thing is a little less volatile today.
Indeed.
All right, we're going to get started. So one, we just want to thank everyone for joining. Today, we're going to be talking about essentially it's the idea of the difference between how do you build wealth and then how do you retain wealth? And what are the differences in terms of when you think about investing, the assets, and what that means? And what are some of those principles to think through? And to kind of go through that, Itai, do you want to give Itai's going to be the one who's really going deep. He's kind of the deep knowledge expert here. Do you want to give just kind of a quick overview of your background and what you and the equity team does today?
Sure, absolutely. So thanks, Mani, for the intro. So I'm Itai Vinik. I'm the CIO, which I'm Chief Investment Officer and co-founder of Equi. Equi is a absolute return firm. I'll dive into what absolute return even means. My career started at UBS, more on the traditional side, and then I launched my own wealth advisory firm as well as a hedge fund that were sold before starting Equi. The idea of Equi is, how can you create consistency? How you can create predictability when you're looking at investment portfolios, and how you can, make them work regardless of the economic environment, if you can think about it really high level. So there's some principles associated with that I'm happy to cover on this webinar.
Yeah, and one of the things that we're fortunate to work with you. One of the things that you and the equity team really excels at is really thinking at this from like a very technical point of view, right? And really, it's almost of all of these things are just inputs to a model. And how do we solve for all these? Today as we're getting started, we're thinking about interest rates, but there's this whole host of factors that drive. You mentioned you're solving for total return, and how do you adjust and manage return and risk against all these different inputs that could affect that.
Absolutely.
Yeah, and then just quick overview. So most of you may know about me and Valor, but just a quick overview on Mani from Valor. I founded Valor with the broad idea is how do we make tax mitigation accessible? So how do you take what do large family offices like the Waltons and other billionaires, what do they do for their clients to reduce their taxes, whether it's ordinary income, capital gains, and estate taxes? And we put together a lot of content and knowledge to help people understand what are those opportunities, how do they compare on a qualitative and quantitative basis, and then we use tools, content, and we chat with people one-on-one to help them understand, and then use technology to make up setting up and administering those structures seamless and also optimized. So today we're going to be kind of going through a lot of topics and really picking Itai's brain on one, what does diversification mean? And what does that mean in a broader context of historically people think about this in I think a simplistic sense is stocks and bonds. People often hear the 60-40 ratio, or boggleheads of different types of ETFs, but what does real diversification mean beyond that? What's the real value? So what does that mean when we think about portfolio theory? Why should you care about it? And this is kind of really to that broader topic of, as you've created wealth, how do you retain that wealth? And a lot of that is tied to these topics. Why is it important to mitigate volatility? And then we'll be jumping to some kind of case studies and Q&As at the end. Any other important topics that you think to just call out that we're going to dive into, Ty?
No, I mean, I think we can take some offshoots from what you said. And honestly, I really like the way you introduced yourself. So I'm going to steal a little bit of that intro and say that whatever those family offices do for their investment portfolio, that's a big part of our thesis as well. Yeah. So, you're helping with the tax mitigation and a lot of these smart estate strategies, but we're using a lot of those type of sophisticated wealth strategies. So I like that.
Yeah, exactly. And I think that the broader piece is like building wealth is, I think something we both think about is it's much more of a science, right? And there's an investment side, and like those components are a lot of things we're talking about today. There's a tax side, and really it's how do you purchase from a scientific thing to really get optimized and get the most value and optimize for there are trade-offs and based on what people are solving for to understand those. So kind of mentioned this, and this is kind of a quick overview on the equity side of, in terms of you guys have raised capital, you guys are venture backed, have a significant amount of AUM and are growing. I know you've kind of been able to onboard some additional big clients, so this number is growing, and then you kind of offer multi-strategy as well as some other, any specific kind of strategies or other things to call out here?
Yeah, so our entire focus as a firm is what we call the absolute return asset class. So that means that we're providing non-correlated investment strategies. So if you think about the stock market being beta is relatively accessible for free effectively nowadays. So, when you have zero correlation, zero beta to stocks and bonds, those are the type of products we're providing for diversification purposes. But we also help with the overall plan of, how you can create, to your point, investing is, I wouldn't call it a pure science, but it's more of an alchemy, right? It's a combination of the art and science. So how you create that type of perfect asset allocation to increase your probability of reducing drawdown, reducing volatility, and increasing consistency. So that's what we do for our clients. And again, we use a lot of technology to do so. We've raised over 25 million in venture, and we've built a lot of systems in order to do what we're trying to do.
Yeah. Okay. And then one other piece to call out is, please let us know as you have questions. Please add them to the chat. We'll either address them close to real time or save them towards the end when it makes sense. But we want to hear from you and understand what's most relevant about this. So jumping into this, let's start with, what's the difference between what you do to create wealth versus what you do to preserve wealth?
Right. So this is the most basic version of the portfolio theory, right? So there's this idea that the more risk you take, the more reward you're going to reap, which is generally correct with some exceptions we'll talk about in a second. No. But there is a significant difference in the amount of risk that you take typically when you start from zero or with a small amount of wealth, and where you get to when you become much more wealthy, right? So you start by starting your own company and you have your own stock and you're putting all your sweat equity into it and you're trying to, make it big. That's kind of the ultimate risk, right? Because every single thing is tied to that single factor. It either works or it doesn't. It's kind of binary. It goes to zero or it becomes successful, right? So you get to that point that you're, quote, zero to hero. And then you have that entrepreneurial success, which is a great thing to have. But what you do post that event, you diversify. And you diversify in order to preserve the wealth and sustain it and grow it over time. Some people don't realize the power of compounding over the long run. So Einstein said that compound interest is the most powerful force in the universe. And what he meant by that is, if you start at year zero and you only make 7% a year, in a consistent manner. I know 7% is a boring number, but over 30 years, you go from 50 million to 400 million. If you have 9%, you're at 700 million. If you're starting at 100 million, you'll be a billionaire with 7% in a 30-year time horizon. So most people don't realize this, but the power of compounding really comes into effect over 10, 20, 30 years. And in order to trigger that compounding effect, it has to be consistent. That is a key rule that we'll touch into why that is, but consistency is 100% key.
Yeah. And this is like kind of the anecdotes, right? Is this interesting thing of people talk about diversification, and right, like it is important to the latter part of once you have wealth, how do you preserve wealth? And this is, what you're hinting at. But there's no one, all of the names we know, whether it's the founder of Nike, Warren Buffett, Jeff Bezos, all of them created extraordinarily extreme wealth with a concentrated bet on Amazon, Nike, that sweat equity, right? Like you don't create outsized gains with outsized risk. And so part of this is, what are you solving for, is to create that wealth or to preserve it. And you have a different strategy for both sides of that.
Very different strategies.
Yeah. And so now this is kind of really how do you preserve wealth, right? And this is a long-term once you've created it. And so this is the whole thing is diversification is very valuable. This is diversification. And it's what is modern portfolio theory?
Right. So diversification is the only free lunch that exists in finance. And I'll explain why that is the case. So this is the classic efficient frontier chart. You've probably seen it in any proposal from Morgan Stanley to, free classes on YouTube. And the idea is quite simple. It goes back to that original chart, which tells you that, hey, the more risk you take on an asset, the greater the return that you're going to get. So if you plot Bitcoin on that chart, like you see crypto, there's a lot of risk, there's a lot of return. Equities are in the middle, bonds are the least. But the reality is if you have assets that are completely uncorrelated to each other, you can get the same rate of return, but you can dramatically reduce the risk. So the classic example is you have two assets that are perfectly uncorrelated to one another. One has the probability.
And just to clarify this, folks, when people say uncorrelated, is there's a lot of assets that so for instance, if, we were talking about interest rates, if interest rates go down, that generally means people make riskier investments. And so tech stocks will likely as a basket go up. So tech stocks are inversely correlated to the interest rate. As the interest rate goes down, tech stocks are likely to go up. Well, I guess that's true broadly of the market, right? As interest rates go down, the market often goes up.
Well, that's not necessarily true because it's the reasons why our interest rates going down. If you go through a financial crisis and there's emergency rate cuts,
fair enough. Fair enough. Yeah.
So it really depends. But the idea is these assets may be correlated, may not be correlated. So like in 2022, bonds were directly correlated with equities. They both fell together. In 2021, they were inversely correlated. So these things ebb and flow with time, which is why it's important to have multiple non-correlated things in your portfolio. So, if you own Coke and you own Apple, that doesn't mean you're diversified. But let's take in a hypothetical scenario, you have two assets that are totally uncorrelated with one another, like gold or S&P. They don't show a consistent correlation over time. If both of them have the ability of moving up 20% in a year or losing 20% in a year, but they're completely uncorrelated, the probability of them both losing 20% in a given year is cut by half. So then you stack more assets like this on top of one another in a portfolio. Now you have 10 of them. What's the probability of all 10 going through a similar loss at the same time? It becomes a very small probability. And that's how you create stability in the portfolio over time, which is why the more assets that are not correlated, that are stacked on top of one another in a portfolio, that efficient frontier gets shifted more and more to the left, but that doesn't sacrifice the return.